Why, why at the first place equity? I'm trying to answer why equity. Then perhaps we will go on to the different types of equity. That is our reading number 4. So if you are and in a lot of situations, because this is all online, I can't see you directly, but I know that you will open your chapters. So you can open. I believe it is reading number 36. It is overview of equity securities. If you are the ones who also do so, completely, it depends upon participants' choice. Sometimes they just want to know and understand what the instructor is telling us. They just want to concentrate on that. There are others who would also probably flip through right now or skim through the pages itself, mark something that, okay, this was getting discussed, etc. The choice is yours. So why equity? And then types of equity is probably a lot about our reading number 36. That is our, so between 1, 2, 3, 4, 5, 6, the whole of the 6th reading, this is our 4th reading. So why equity? Even before that, I have to tell you that there are in any kind of ecosystem, in any kind of environment, market environment, economic environment, you have two types of people. So this is the first type, and this is the second type. The first type is people who have surplus money, and here people who have insufficient money, insufficient to meet all their money goals, insufficient money. So during COVID, what really happened? There were at least few of the industries which were badly hit. Travel and tourism is one of them. Complete lockdowns. So nothing was happening. At that point in time, the ones who belonged to, let's say, the airline industry, the second example, I can also give you the fitness industry, specifically gyms. So the gym instructors, etc. So all of them, they were really, really short of money. Their savings was also not kind of substantiating them. They were the ones who were having insufficient money. And that time they were looking to, they were looking to borrow money, to get it from people who may have surplus money. And here we call them as borrowers. Now the ones who were fortunate enough, who probably were running like very good either businesses or have had very comfortable and high paying jobs, etc. They've had surplus money. They are the ones who are in a position to invest. They want to save their money. By saving itself doesn't mean it will not generate any wealth for them. Investment generates wealth for them. Okay. There's a difference between saving and investment. Saving could just mean if I have got rupees 10,000 with me and I put it in my almirah and forget it for the next 1 year, I have saved it. Investment means that this was my rupee. Investment means when I will grow this rupee. Okay, investment means that I will grow this rupee, and after my horizon, probably I have more money. At least that is the whole objective. So the entities or the people who have surplus money, they are known as investors. Now, if I am in short of something, for example, I do not have vegetables. So for example, I do not have potatoes or onions or tomatoes. Where will I go? I will probably go to an agricultural market, but we don't have to go to an agricultural market because now we have plenty of options, including the vendors. Likewise, if I do not have a medicine, where would I go? I would probably go to the area where there are chemist shops. So what do? We then, as buyers or sellers, as buyers, they want to go and meet the sellers. Usually all of us, where we will go to a market. Here, what is the market that is called, where investors and borrowers can come together so that they can exchange money for whatever purposes that they require right now. We call this, then there are several names to it. We can call this as a financial market, or it can be also call it as a capital market. Okay. Now I move again to the people who are either investors or borrowers, but I would want to begin with borrowers. What are the types of borrowers? Borrowers can be people like you and me also, right? Then it can be our governments. It can also be corporates, firms. So over here, the corporates, they are also in need of funds. Why are they in need of funds? They want to expand or they are short of money. So all these young startups, they are also short of money. So they also want a lot of, they would want to raise money perhaps. And we saw a flurry of IPOs that got happened in 2020 or 2021, where there was actually a party time going on in the stock market. So all these private companies, they became public companies and they raised funds because they were having insufficient money to reach to their corporate goals. So here corporates had the option of rolling out, or as we say, structuring something known as IPO, where essentially what they did was they sold their equity stakes. Now, if any of you who is not having even a background to what equity stake is, I'm also going to tell you that in a company, when a company starts, it requires some financing to it. That means it will require some cash to start also, to expand also, to generate its operations, day-to-day activities also, and expand also. Who will give them these cash? Broadly, we say there are two types of entities: equity holders and your debt holders. So you can secure a bank financing, those become your debt holders, and the ones who can give you money and who can give you this money known as your equity. So in lieu of this equity, you also offer them ownership position in your company. That is a major difference between if you are an equity holder or a debt holder. There are many differences. I'm just starting here. If you can become a co-owner or an owner of a company by purchasing, by first of all putting your surplus money as an investor, we say that you have become a equity investor. So let me say that there are a couple of equity investors. First of all, it could be the founder, who is like the promoter. Okay, so he can put in equity money. Then your family and your friends. Then next upon, we have a category known as angel investors. Who are these angel investors? Who invest pretty early in the company's life cycle stage. Then perhaps, we can also have private equity. So private equity is under your alternative investments. We can also have venture capital. Venture capital is more appropriate if it's a young startup. Then we can tap our public market rather. The public market, which I was mentioning over here. So these are, yes.
How private equity and angel investors are different from each other?
Yeah, why not? So you see the word private equity. So I will tell you, this is a very commonly asked question that also at one point in time I have penned down an article, but that's about a later story. But it's a very commonly asked question. So we have angel investors, and then we say something like, it's a private equity player or a VC player. First of all, let me tell you, the broad area is private equity. It's an umbrella. It is an umbrella under which or within which you have subcategories of investors, subsegments of investors: angel investors, or your venture capital investors, or growth investors, or a lot of, as we say, strategy wise also. Angel investors, for sure, they are amongst the first investors who are outside the promoter or family friends group, or your family or friends group. Okay, so they are the ones, if this is the life cycle stage of a company, it has begun at T0, and we say that, this is like a life cycle stage of a company. Until here, it was all the funds from the company's founder or the promoter or the family friends. When you start tapping professional investors, The first set of investors is known as angel investors. Okay. Then later on, we have dedicated firms known as private equity firms. And their business model is only such. So private equity firms, venture capital firms, what is their business model? Their business model is that they would want to invest in some very, very brilliant ideas, and they want to enter early also, so that when the IPO comes or subsequent sales can be done, they can generate what we call it as a very healthy return, a very healthy return.
So
So
we
the
can that
yeah,
under private equity, angel investors come. Like
yeah, private equity is the broadest term. ठीक है
okay,
मान्या,
and
private
under this
equity.
promoters and everyone comes, right?
नहीं 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 नहीं, promoter, private equity is
Okay, okay. Promoter
promoters,
is the founder. Okay, okay.
founders. Yeah, they are founders. So you know, if any of you, if for example, if your friend, she is opening an e-commerce company, है ना? So
Mm-hmm.
let us say this is pretty much in vogue right now, handmade soaps, handmade beauty products. So your friend is opening that up. First of all, she may put money from her side, then she may
Yes.
ask you as a friend, she may ask
Hmm.
her mama ji or chacha ji, that is from family. But if she wants to even grow further, she wants to expand, who are the first professional investors who
That
will
would be
probably,
angel investors.
they are angel investors. Then we have dedicated firms known as private equity firms. Okay?
Okay, ma'am.
Yeah. So here what happens is that if you were to probably ask these angel investors or private equity guys that please, give us money. They will not give you money just like that. So they will give you money. The golden word is in lieu of, in exchange of ownership position. Ownership position. And if you were to have an ownership position, what is that written document? What is that written document that you will perhaps have, so that tomorrow if you were to sell this, etc., that is known as a security. And over here, this is nothing but our equity security. Okay? As compared to a debt security or any other form of security. Is it clear to everybody? Now, what is equity
Yes, ma'am.
security? Okay.
Yes, ma'am.
Great. Thank you. And please do not let me go ahead if anything is not getting clear. Now we are on that we want to become owners of a company. Now we wish to become owners of this company called Company A. We have got different options. If now readily you want to ask, ma'am, should I, opt for this option or should I ask from that option? The answer is entirely this depends upon your own risk return appetite. Or if you are representing any of your client, then the risk return appetite of your client. Okay? So by risk return, so for example, as you all may be already aware of, so we have now, we call it something as a debt security, a bank loan, and then we have something here, this is equity. So here, when we have to choose between debt and equity, we have to remember that yes, the return is higher in equity, but so is the risk. You are only getting compensated in this by choosing an equity security because you are choosing a higher risk. Okay, that is the same within equity. So within equity, broadly what we have is we have common and we have preferred. We have common and we have preferred shareholders. So if we buy common stock of a company, we become common shareholders. If we buy preferred shares of a company, we become preferred shareholders. Okay, why will we do that? Now it is for us to decide that if we want to take more risk out of these two, then common stock is more risky. Common stock is more risky rather than your preferred stock. Just one moment. So common stock is more risky than your preferred stock. I will tell you over here. So here we have common stock and here we have preferred stock. What happens is that God forbid, if this company is going into liquidation, that means it is going to get bankrupt, it's going to get shut down, as we say, the simple word is shut down. So then what happens is so for example, in previous years, Jet Airways, and it's getting liquidated, bankrupt, operations have been shut down and whatnot. So then the first task that everybody thinks of is that what are its assets? If we start selling its assets, then as a stakeholder and then shareholder, what is it that we will get out of it? There is something known as a hierarchy of who will be paid first, who will be paid second, who will be paid third. So you try to assess that, okay, if I were to, I really, these were all my options, and I cannot now survive here. I have to shut down my shop. So then what are or if I try to sell all these assets, what is the money that I have? So I'm just putting this rough figure, considering it was a company of this size, that it is 50 lakh rupees that you can get. Who are the first ones who will get money out of it? They
Debt
are
holders.
your perfect. They are your debt holders. After this comes our preferred
Preferred.
holders,
Yeah.
and then comes our equity holders. So if you are willing to take the maximum risk, you will participate and purchase equity security. If you want to play safe, you will choose preferred security.
Okay.
Within preferred also, now there is another game. The other aspect of here is the between debt and preferred. That debt, you have to pay interest to your debt holders. Like, you get a bank loan, you have to pay periodic interest. So it could be like your home loan also, and I believe these are very, very commonly used terms. You all know that. If you
Yes,
yeah, you will never get bank loan for free. You have to give something back. Here also, preferred and equity, they get dividends, they get periodic dividends. Here also, when you have a periodic dividends, they are also in a preferred, means that they will have a priority in dividend payouts also. Priority in dividends payouts also. So there are a couple of things. Please, I hope you guys take notes, whatever I do, whatever I write, okay? Priority in dividend payouts also. And secondly, what will happen, that they have a priority when the company is going to go into liquidation. So they are going to be paid first. This we have discussed. And remaining ones we will study. So I'm just giving you 1 to 2 moments. So priority in dividend payouts, in during liquidation time, they are paid first. Then there are other options of our equity. And I would encourage you, let's go through all these options one by one. And again, depending upon how much risk you want to take, even within preferred also, there are certain securities which are very, very safe for you, extremely safe for you. But there can be others also. For example, we have a subtype known as participating preference shares. So again, it will depend upon your own or your own means your either yours or your client's own preferences. All right, with all this background now, let's begin. So common shares are the most common form of equity and represent an ownership interest. I am sure now that this line is clear to you all. Next is preference shares. Let me read this, that preference, they will have features of both common and debt. Why they have a feature of debt also? Because the preferred shares, they have something known as a fixed rate preferred dividend. A fixed rate, like we have a fixed rate interest, we also have a fixed rate preferred dividends. Preferred dividends. So it could be 10%, it could be it could be 5%, it could be anything. Just like we have interest rates also, 10%, 5%, etc. Which is why we say preferred stock is having features of both common and debt. Like common stock, preferred stock dividends, they are not a contractual obligation, and shares will never mature. Common stock, you become an owner, you are there forever. But when you take a bank loan, you take a bank loan for 5 years, you're just there with the company probably as a stakeholder for the next 5 years. Okay. But this security will mature, your debt security, your bank loan will mature. The common shares and preference shares, they will not mature. And, like debt, I was just telling you that you can have a fixed preferred dividend. So it is having both. All right. Next is, what is cumulative preference shares? So here, let me tell you with a quick example, what is this cumulative preference shares? And let me say that we have certain years. So anybody who doesn't know what a dividend is, Then I will also want to tell what a dividend is. Anybody who doesn't even know what a dividend is? Okay, so I will take the silence as acceptance. So every year, the company's management, they decide how much to give the dividends. And for year one, year two, year three, there is something known as dividends declared. And let's say this is for the preferred shareholders. Preferred shareholders dividend declared for year one was, and I'm giving you all a cumulative amount. A cumulative amount of, that means a combined amount of all the preferred shareholders. Let us say this was 10 lakhs. In year two, let us say this was 11 lakhs. In year three, let us say this was some 12 lakhs. But what is happening is the management is only declaring. The management is under no obligation to pay them for sure. Again, one of the major differences between if you want to have a bank loan or you want to go with the equity security or a dividend. Okay, so here dividends may be declared. I mean, next they may declare the pay, and what we observe is that yes, if the management has declared, more or less they would want to. But if there are situations that's very tight, so all of a sudden this pandemic comes upon, all of a sudden the Russia-Ukraine war erupts. So then they want to be conservative. They want to probably not give these dividends as payments to their shareholders, and they want to retain. So let us take this example that they were not able to pay. They were not able to pay. So year one also did not get paid. Year two also did not get paid. And perhaps by year three, they said, okay, we are in a very comfortable position. So if you have purchased a security known as cumulative preference shares, then the management is obligated to not just pay you 12 lakhs, but 11 lakhs also and 10 lakhs also. Okay. So you will not just get 12 lakhs, you will also get any form of unpaid dividends from the previous years. That is to say that your dividends, if they were unpaid, they were accumulating, they were combined. So let's read here. Cumulative preference shares are usually promised, but any dividends that are not paid must be made up first before common shareholders also get, and even the preference shareholders also get. So please, I mean, before common shareholders is now taken for granted. That is why you are preferred shareholders, because you will get it before your common shareholders, but they will also accumulate. And non-cumulated means they will not accumulate. That's what I was trying to say. Now, if it is non-cumulative and in year three, you think that now we are in a comfortable position to give, then non-cumulative means you will only and only give this 12 lakhs and no further than this. Okay,
Ma'am, the only difference between preference and debt is that in preference shareholder we will give the dividend in case we make the profits, right? But in debt
yeah.
we have to pay the interest. And
Yes, correct.
in
Very good,
case of
Manya.
cumulative preference share, we have to
Yes.
pay the dividend no matter what, like no matter at
No, no,
what
no,
time
no, no.
we have to pay.
Ha. Yeah, nahin, as and when we feel comfortable, we will pay. But then we will
Yes,
have to pay for the earlier years also
yes,
in
yes, yes.
cumulative.
Yes, ma'am.
All right. So let's go ahead now. And anybody, please, I am all ears to all of your queries. Then we have another interesting point with us. That is, you can also have an option to convert yourself. You are a preferred shareholder. You have an option to convert yourself into common shareholder. Okay. So what are the benefits out of it? I think we can just straight away read these advantages. That first of all, you will get a higher dividend. The preferred dividend, right now you want to be a preferred shareholder because you are getting a higher dividend than your common counterparts. Next, it is the firm now becomes very profitable. So once the firm starts becoming very profitable, now you know that over here I am to just getting like 10% every year. But then now my common shareholders, because the company has become successful, it has become more profitable, Common shareholders are getting better, and they are getting better payouts in dividends. So it is all about your EPS, right? It is all about your earning per share. That is all about whatever profits we have right now, net income. So for highly successful companies, they will have larger base, a larger amount of net income. Once they are they have they are through with paying the obligation of preferred shareholder, the entire amount will be there for the common shareholders to the amount, not the whole of it. It's never the whole of it. It's divided into how much they want to pay as dividends and how much they want to retain. Okay. So that's the next decision. And I'm talking about this. So then you would say that, okay, now the firm is like profitable. So if you have this option, now let me convert myself into common shareholders. Next about, let's say, conversion option, please read it for now, but I am sure that you will get to understand more with FRA because we have numericals around it, okay, with regards to these conversion options, and also in your kind of, in your derivatives, etc. So please allow me and trust me, as in when I say to for a particular point, that it is much beneficial, that, and more clarity will be there if you will, for either you have already learned or you will know this point, let's say under FRA, let us say under your debt, etc. So please just trust me. At the end, I am here. I'm not running away. I'm not running away. If you have any doubt, etc., I'm just like a message away. Okay. So next is that preferred shares, they will have less risk than common, etc., etc. But then you retain yourself as a preferred shareholders, because in the event of liquidation and the other advantages, you still enjoy. So you still enjoy yourself of all the advantages of a preferred shareholders, and with an option that where you feel that, okay, probably now you know this company also better. Earlier you were not even aware of this company a lot, but now you know this company. It in its life cycle stage also, as we say, a life cycle stage. We are the next chapter is, it will give us a life cycle model, that this the company is doing very well. Now let me convert myself into common shareholders. I am ready to take more risk. All right. You can just let me know, ma'am, anything, any term, anything, do not let me go ahead.
Ma'am, what
Yes,
was
yes.
non-cumulative preferences?
Yeah. Non-cumulative means that in year one, 10 lakh was not paid. Let me use a different color. 10 lakh was not paid. Year two, 11 lakhs was not paid. In year three, when you declare 12, non-cumulative means you will only and only
Yes,
pay
12.
12.
Okay.
Okay? And cumulative means you will not just pay 12, you will also pay 10, you will also pay 11. All right? Are we good to go
Yes,
ahead?
ma'am. Yes.
Okay. So here, this is, so I just told you about, a private equity firm. Now let's leave aside that private equity firm. That's a different story altogether. That is a business model. That is a business model. I'm not touching that right now. I am touching that in your equity also, who is the issuer. So now you guys understand what an equity is, an ownership position, and you would want to become an owner of the company solely because you are believing in this company. It is like a wealth generation. It has the capability to generate future wealth for you, and that is why you want to, and you have extra money also right now. You want this money to grow, and amongst a lot of investment vehicles, as we say, options, as we say, you become an equity holder. Now with an equity holder, you decide whether you want to go with common shares or you want to go with as a preference shares, and you probably decide it is common share. Okay, so on and so forth. Within that also we have certain other aspects. Now we are now deviating from this topic, and we are now deep diving into something known as who is the issuer. Who is the issuer? Issuers here can be categorized into two broad categories. One is public and one is private. Public firm or public company and private company. Can anybody tell me the difference between a public company and a private company?
Ma'am, the public company has their stakes at the public level.
Yeah,
The
in
IPO issue.
exchanges. In exchanges, है ना
They're
भैया?
traded on the stock market.
Right, Vanshika. Correct. TK Abhigyan, what you were also saying was right. So it is traded, we have an exchange, it is traded in the market. So you and me, if we want to purchase shares, we want to become owners in a private entity, we can do that. But it doesn't happen in private companies, and that's the main difference. Now, the equity ownerships of a private firm is known as private equity, and the equity ownerships of a public firm is known as public equity. Okay. So what are the characteristics? There are certain special characteristics of a private company's equity as compared to public company equity. You know, when you become a public firm, you are now obligated to the to all the financial participants. So you have to share your financial statements. Then there are so many reporting requirements also that you have to do. You register yourself with SEBI, that is our controller, or rather our regulator over here, and you have to comply with a lot of exchange norms. You wish to list yourself on NSE, that's National Stock Exchange, or BSE, that's Bombay Stock Exchange. What is it that you want to do? So there is a lot of obligations when you become a public firm. But when you are a private firm, then you do not have to undergo and reveal your financial statements, etc. So you can just pick up any of the private company which you know right now, just Google it out. You will not find their financial statements or annual reports, and you will not able to find the balance sheet, profit and loss account, or cash flow statement of those private companies. But if a company is trading in the public market, you will definitely get their latest financial statements and historicals also. So here in this slide, we are talking about certain differences between public firms and private firms. So can you see here? Lower reporting costs for private companies. More limited firm disclosures because no government or exchange requirement to do that. Okay. And I was just telling you that public companies have higher obligations, responsibilities to investors at large, to public at large. Private companies, they don't have that kind of requirement. So then, you know, the management, whatever their internal controls, the way they are handling their corporate affairs, the way the operations are running, it is not in the public eye. It is still whatever is happening. So if our friend, she is opening this home based all natural beauty products line, launching her own line. I mean, whatever she is doing, she may be hiring 2 to 3 other people, etc. Whatever she is doing, she is doing in her own space, out of her home, or probably out of maybe somewhere else. Whatever, it's still whatever is being done, it's her own. But when you become a public company, then a lot of stuff you come into the public eye. And because of all of that, there is a lot of burden on the management of the public firms. There is a lot of burden on the management of the public firms. Whatever they will announce, they either come onto the television, or they give interviews which are published in our newspapers. Whatever they announce, the investors, their shareholders, they will either take it as positive, or they will either take it as negative. If it is positive, the shares which are there, they will go up. If it is negative, the shares, it may go down. So in the short term, this is in the short term to medium term, etc. So, you know, always and always the managements are concerned that, oh, if you are to announce, or oh, if you are to do, this is a bit disadvantage of a public firm. While the private companies, they can fully, and you know, without any kind of burden, they just probably focus not just on short term, mid term, but long term, because they do not have, there is no public pressure for short term results. Okay. And the other thing is, I'm sure you guys already would be aware of, it's a public firm. You can purchase the security right away. So we will say that they are, the public firm is having more liquidity, and private firm ownership is having less liquidity. Liquidity means you can't, if you have purchased a private equity stock, you can't sell it right now because there is no share market that exists for private equity. And the share price also for a public firm, it is determined by, if you have already know or you know about the law of demand and supply. So it really depends upon the financial participants to decide upon your share price. So it is determined by the market. And private equity, it is not determined by your market. So I will read once more all these quickly, these special characteristics. It's very important for us to know, because later on, towards our level 2, we will have something known as now private equity valuation. And I specialize in private equity valuation. So therein we take care of all these special characteristics and we tweak. That means we change our valuation models and our assumptions, because now we know that it is a small private company and not a big public company. Okay. So first thing first, there is less liquidity. You can't readily sell the private equity somewhere because there is no market. Share price negotiated between over here, probably between, let's say, what I was mentioning, the firm's founders or management, and between its angel investors or VC firms or others. So those are your professional investors, and not by the market. Wherein public firm, it is by the demand and supply and coming from the market. More limited firm disclosures, they don't have to give all the financial reports. Okay, they can keep it to themselves. Lower reporting costs also, but weaker corporate governance, because whatever you do, it is inside. You may engage in certain malpractices. I'm not saying that all of them will. It is just like there is a kind of the chances are there that you may engage in malpractices. Next is that you have a greater ability to focus on long term, because you do not have any short term pressures. Next, potentially greater return for investors when the firm goes public. So this is why there is so much pomp and show with our initial public offerings and IPOs, because IPOs, they gave a chance to all these professional investors who invested as equity investors early on in the life cycle of a company, and now they are given a chance to sell their holdings in the public and generate higher return. Okay, all right. Next is, now we are bifurcating into 3 categories. Again, something is there, but we, under our alternative investments, we have much more detail. We have much more detail to what a VC is, what an LBO is, etc. But I am still telling you. So now, what the first part was a private company. This, you can just say that who was this private company? Our all organic beauty product provider company. So this was the company which was a private company. Now we have a set of professional investors. You know what their business model is? Their business model is, please look at over here. Their business model is, they want to enter right now and they want to pay P to acquire a stake, mostly in a private company. Let me say this is ABC. Private company ABC. Which is this private company ABC? It could be this company. It could be anything in your IT segment. It could be anything, your e-commerce company. And it is anything. It is anything. They choose these types of companies, and if they believe that it is having a very good potential, then they invest in them. So here at TT0, they put in P. The business model is, they wait for 5 years, 10 years. They also engage and help in the operational matters of this private company, ABC or PQR or XYZ, whatever. And their whole idea is to sell off. So here they bought the stake, equity stake. Here, let us say at the end of 10th year, they want to sell. I mean, 10th year, but in my, so when I had entered the corporate world, that time we used to say, within 5 years. And you would want to have more money than you originally invested. So here I'm writing 2 times. That means you were able to double your money in 10 years. This is the business model of certain professional investors, and these investors, they launch their firms. These types of firms are known as private equity firm. Something which I get asked a lot, and that is why I am telling you. Difference between a private company and a private equity firm, a PE firm. So a PE is like an umbrella definition, a broad definition. Venture capital is like one subsegment of private equity. So what are the names of these examples? SL is there, Benchmark, Index, GGB, Founders Fund. There are many others private equity firms. Also, for example, Bain Capital, KKR, Carlyle, etc., etc. Okay. So within that, you see, if you and now it all comes down to point here, that where is it that you are entering in the firm? So this is the life cycle stage of a firm. That means from T0. So let us say I'm just writing 50th year of its operations. First, don't we see that there is a very, very high growth? Then we see that the growth kind of, the growth matures. And then we see that the growth declines. So here, when you are right in the beginning, somewhere right in the beginning, super high growth phase of the life cycle stage, and you are investing, over there, we call it as venture capital investors. So there we have certain terms associated with this: seed, startup, early stage, mezzanine financing. Over here in our equity class, we are not going to go deeper, but this is what we see is that they will provide capital. They will buy the ownership positions in the firms early in their life cycles to fund for the rapid development and growth. Okay. Now, I have already told you all investors could be anybody else, etc., etc. So this I have already taken care of, and then ultimately IPO will happen. And this was your VC. Then there is also a term known as leverage buyout. So in this slide, even if you look at your books also, yeah, like in here over, it's just like probably we just need to know in 2 to 3 sentences what the terms are, because somewhere else, which is alternative investments, is where we will get further details of these pointers or these. But still, if you feel like that, ma'am, please tell us more in detail, I'll be happy to do that. Leverage buyout is where you use debt, where you use rather a very high debt. That means you use a very high amount of bank loan while you are purchasing a company. While purchasing a company. Okay. So, so for example, there is $100 million required for an investment bank or whatever the case is, for an acquirer to acquire a new firm. So how will the entity raise the fund? That is about if it's using a very high proportion of your debt, So 70 million is coming in the form of bank loans and 30 million is coming from your equity investors. We say we have engaged is something known as leverage buyout. Buyout means you are buying a new firm. Leverage over here means you are using a lot of debt or bank financing. Okay, so I have just given you 70%, 80%. In reality also it is like this: 65%, 70%, 80%, very high debt is used. And as we say that if the current management is the one who is buying, the term is known as management buyout. Management is buying it. Okay, I will pause here.
Uh,
Yes, please.
What is the difference between the venture capital and angel investors? Because both of them are investing in the early stage.
So in this early stage also, angel investors will put in first and then VCs come. Usually, generally, that's the one. That's the hierarchy. That's it. That is it.
And ma'am, is there any difference between private equity and private equity firm?
That's what I told you, na, Abhi. The private equity firm, the business model is this. So just 1 second. Whose question is this? Abgyan, is your question?
Yes, ma'am.
Yeah, that's what I just mentioned. I'm happy to repeat again. Private equity firm, the business model is such. They will choose these private companies like, Nykaa, Zomato, etc., etc. They will first of all find these companies which can become like can give them bumper gains, which can become super successful in the future. They will identify these companies and invest in them. How will they invest in them? By becoming equity owners. That is our topic for today, equity ownership. Okay? So here at time t0, they become the owners and they pay a price P with the expectation that after a couple of years, 5, 10, 12 years, they would want to double their money or triple their money or whatever. However much money they will get, they'll be always very, very happy. Okay? That is a
Okay,
private
ma'am.
equity firm. Okay?
Uh,
Now, VC firm is also a subcategory of your private equity firm.
Okay, ma'am. Ma'am, I just had another question.
Yes,
Ma'am, in your
yes.
slide, I guess it was written somewhere that after going private, after going public, all the investors do have more gains.
They do have more
Gains, or I would
gains.
say,
That
yes,
is the
ma'am.
expectation. Yes, potential. It is an expectation. Is it a reality or not? Nobody knows. Okay? That completely depends upon company to company, investment to investment. Some investments they give us bumper gains. Some investments we run into losses. It is just an expectation. On
Okay,
an
ma'am.
average, it is an expectation that if you're investing in these private equities and not in these public firms, again, it is all about your risk. This is a wonderful question. So here it is your public stock, public equity, or here it is your private stock, private equity. Again, you would want to here, if you wish to invest in private stock and not public stock, the expectation is higher return, but it will come with higher risk. The choice is yours.
And ma'am, this generally happens on the IPO's time, right?
Yes. IPOs as well as secondary sales. But for now, if you understand it will happen in IPOs, I'm more than happy. That's what we want to understand. That yes, during IPO time.
Oh,
All right, great. So now it's time for our quiz question. Now the whole drawback of not running a presentation over here will be that I will not be able to do some things, and this is like a PDF now. That's why I tried to go into PPT part, but it's okay. Let's go ahead. So the advantage of participating preferred shares versus non-participating preferred shares. But I haven't told you what is a participating preferred shares. I will tell you now. What is a participating preferred share? A participating preferred share. So they are preferred shares. Okay. They are preferred shares. If you become participating as well, you can have extra dividends. That's the definition. There is even a potential to get extra or receive extra dividends. So can you please just write one line over here? Participating is where you can get extra dividends. And usually, with certain companies, they want to actually entice their investors. Please invest with us. You can even become a participating preferred shares. So if in a year we will have a lot of good net income and we will announce also dividends, then we will give you extra dividends. Okay. So we know about,
Ma'am,
yeah.
तो extra dividend किस base पे दे रहे हैं?
Yeah. So first of all, they will for sure get their 10% dividend. ये तो मिलेगा ही मिलेगा. This तो they will get extra dividends, especially when during a particular time period, during a year, a company does exceptionally very well. So in a year, let us say that their net income is very high. So usually it was about, let us say, 50 crore. But this year, the net income was 75 crore. So the management also has extra net income to give. Likewise, they would give a proportion to it. So this is all set. Once you sign the documents to become a participating preferred share, this will all be set that you will get some extra dividends. Let us say you will even get some extra 10% dividends out of the increased net income. So on 25 crore, you may get like a 10% over and above your usual 10%. Is it okay?
So there's no other difference than this one, right?
Yeah.
In this case, everyone would prefer to be a participating preferred shareholder, right?
Everybody would, but not all the firms, they will kind of
Yes, yes,
launch participating preferred shares. But if you're given a choice, if I am given a choice, I would want to become a participating preferred shares. Why not?
got it,
Okay.
ma'am.
Okay. Next is compared to public equity, which is the following is least likely to characterize private equity. So least likely to matlab ki lower returns because it is less liquid market. No, 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 no. It is less liquid market. We have an expectation that we are taking more risk. We are just having an expectation of higher returns. अभी वो रियलिटी में होता है कि नहीं होता है वो तो हमें बाद में ही पता चलता है बट आर एक्सपेक्टेशन व्हेन वी आर बाइंग a private security is a private equity security is that it is less liquid, we will not be able to sell it as and when we want, then we should be compensated with the additional risk by giving us higher return. Okay? So question number 1, the answer is receive extra dividends. This is simply the definition of participating preferred shares. And here, this is coming from our slide, difference between public and private equity. Okay, now we move on to that further on. I was telling who the issuer was. Within this, I also told you that there is something known as private, there is something known as public. Then now I am going to tell you, we can even differentiate the issuers. We are still under the whole concept of issuers. Then within this also, we can cater to the geographic region. Whether it is the equity stake that we want to buy, is it the company, is it from our home country, or it is a foreign country. So what is our home country?
India,
Yeah, and what could be certain example of a foreign country?
US, Canada, Europe.
Very nice, very nice, very nice. So we are sitting over here in India. We want to buy shares of Google, Tesla, etc. In which stock exchange we have to go? We have to go to the stock exchanges which are there in US. For example, NYSE or Nasdaq. Okay? So that is what it is for about foreign equities. But we also have to simultaneously understand the equity risk. Here again, I point out this again, this is not going anywhere. This risk return conundrum, as we say. Here, this is our domestic home country equity, and we have our foreign equity. Here, if you wish to participate, you want higher, there is a higher return potential because it is coming with higher risk. So we are just going to talk about these risks now. What are the risks if you want to purchase foreign securities? And here securities, we are putting precisely, it is equity securities. Okay. So let me flip now. Let me flip. Right now, I told you we are here in India and we are looking for a foreign country investment. Let me flip. You are an investor and a very big investor. Let me say a mutual fund house, etc. Okay, a pension fund, etc. Based out of US, and you are looking to invest in emerging economies like India, Brazil. Well, writing Russia right now, I'm not so sure what has erupted beginning in 2022. But then we used to have something known as, remember, BRIC countries. So China is the other one. But now, definitely the definition of emerging economies. Now we also have Philippines and whatnot. We have so many. So this guy who is based in US is looking for investments in India, Brazil, Russia, China, or let us say Africa. He has to be aware. He has to be aware of the risks. So let us just first read the slide and then I will tell you everything. Direct investing is the securities of foreign company. In the securities of foreign companies, it simply refers to buying a foreign firm's securities in foreign markets. Buying a foreign firm's securities, so Tesla share, Google share, in your US stock exchanges. But there are certain obstacles. First of all, the investment and return are denominated in a foreign currency. For us, it will be denominated in US dollars. For the person who is there in US, for him, it will be denominated in rupees or any other currency. Okay. Next is the foreign stock exchange may be illiquid. It's not really touch wood the case in India, but let us say it can be a case in Africa. After the Ukraine-Russia war, Russian stock exchange, that is also illiquid. That is another risk that you have to face. Next, there can be some reporting requirements because you see for foreign exchanges, and you are very much familiar of what is happening in US. If you were to kind of invest in India, Brazil, Russia, China, Africa, you have to understand what kind of reporting requirements are there. Maybe, the cases, they are less strict because it is probably assumed that the reporting requirements of US based companies, European companies, they are more strict than our emerging economies. A lot is happening, but still it is like you can say a vision in the minds of the investors. Next upon, similarly, you have to be quite familiar with the regulations, procedures, how are these economies they are operating. We really in US they really want to know how is it that NSE performs, how is it that the BSE performs, is there any risk, what is kind of, as we say, if they were to buy the shares, when is it that they will get it actually in as a demat, the digital form of the security, how many days they will actually become the equity holder, is it going to take them 1 day, 2 day, what is the other thing that you may know of. So there is something known as short selling, which means you can't sell a security if you can't buy, if you already don't own it, something known as short selling. So short selling, it is not allowed in India. It may be there in US. So you have to be familiar with the regulations and procedures. Okay. So these are the top risks where you have. So there is currency risk, there can be liquidity risk, there can be additional time which you have to spend to learn about the reporting requirements, regulations, and procedures. Because if you have missed a very, very important point, then perhaps your investment, you can have a loss from your investment.
Yeah.
Yes.
And then we have to invest in the foreign markets. Like, what
Yes.
is the process of converting our currency from rupees to dollars?
So Vanshika, actually, the banks only help us a lot, na. So probably, when we have when we receive something, it is also in our bank account. Then we have to, in according to the instructions that we give to our bank representative, they will change it to rupees, and we will extract that in rupees from our ATMs or via checkbook, etc.
So banks also charge something.
Yeah. Banks also have their per transaction commissions.
And now what is short sale?
Yeah, so short sell, it is not in your right now in your equity. This was just one example. It is not in your book, but I will tell you. Very simple. Short sell means you sell a security, for example, Maruti Suzuki share. You sell it first, you get money, you buy later. Now you had the money, you use this money to buy it. What will be your expectation if you are entering into a short sell transaction? Your expectation, the big word over here, expectation is that you are selling at a higher price. That means you are selling it at 120. The share price drops. It becomes 100. You buy, you have already got 120, you buy it with 100 rupees. Expectation, it is a risk. If it goes against you, if the market goes against your expectation, what if from 120 it becomes 140? You are in some form of losses. Okay? Otherwise, if your expectation is right, it's a 20 rupee per share gain for you. And it is really a very high, it is like a risky kind of I would say a transaction. Okay, Manya?
Yes, ma'am.
So that is why I'm saying short selling, it is not allowed in India, but there are certain economies or countries like US and Europe, they are offering short sell. So wherever you are, you just have to know about their procedures in detail and then only engage and purchase foreign stocks. All right, everybody, you guys have been. So the next point over here is that there is again we are in a foreign, for like in a foreign market. We want to buy securities in the foreign market. Likewise, what happens is that there are. Let me just go at the top here. Now, what happens is that so it was from our investors' point of view. So as investors, we have surplus money, we want to buy shares, we are willing to take more risk. So we go outside India and we want to buy shares, let's say for stocks which are trading in US or Canada or Australia. That is from the investor's point of view. Now, from the firm's point of view, what they can do is, let's say at the IPO time, initial public offering time. Okay. So in the firm's IPO, then also these firms, they have few choices. And one second. So I'm just trying to see, whenever you guys speak so that I readily come to know, there was some option. Actually, I'm using Zoom after a bit of a time. I am totally on MS Teams for a while. There was actually an option that tells me, but maybe I will figure it off in the beginning of the next class. I do not want to and wish to waste any time. No worries. Then during the time the IPO is coming to the market, the firms also, they can list in the home country. They can list in foreign country. Okay? So more or less, we see it will be our home country. Now, the second option is they have listed in the home country. So this one is done. This one is done. Then later on, they can also list on a foreign country. That means the stocks of the same firm. And we have a couple of examples from India. We have Tata Motors, we have Infosys, etc. I just want to write two. There are a couple of them more. So we will see that they don't only just trade on the Indian bourses. Bourses mean stock exchanges of NSE or your BSE, but even perhaps on, let us say, NYSE or NASDAQ. So the way now it happens is that Tata Motors or Infosys. So I'm taking one example of Infosys. So what they will do is they will, kind of approach a bank first. Bank in the US. They will transfer some amount of equity shares to this bank in US. This bank in US will further do all the proceedings with NYSE, NASDAQ and everything, and the investors of, let's say, NASDAQ and NYSE, they will be able to purchase the shares of Infosys. So two things over here. There are a couple of options where the firms, which is we call it as IPO destination. Is it home or is it away? It can be both actually. You can list in your home country, you can list in your foreign country, and Indian government, they don't have any kind of restriction. They in fact want that because in India, more or less, they are like capital starved firm. So now we have given a technical word that you have to remember, known as a DR, depository receipt, that you have deposited a security or they have received a depository receipt. This is a technical word for all this. Simply means if you have understood the process, please do not complicate it any further in your mind. Infosys wants to have money from Indian investors, they can launch it on BSE, NSE. They want to go and they want to, have funds from the American exchanges and their investors also who are active on NYSE or NASDAQ. So NYSE is your New York Stock Exchange, etc. So they also want to tap more funds from the foreign market. They can list over there. But the way they will list is in between, they require a bank. This bank is known as a custodian bank. This custodian bank means they will have the custody. The shares will be in their custody and will be given to these investors which are based in a foreign country, which is US in this case. So this is a depository receipt. So we will not say that investors over here, they have directly purchased the shares of Infosys. Now the word equity stake or share has been replaced in the foreign context in the form of DR depository receipt. Okay. I understand there are a few terms that you will learn over here. Depository receipt, GDR, going forward, ADR. ठीक है, अभी क्या होगा that there and for I know that for a couple of you already have done a couple of subjects. So the way our game plan should be, that there will be certain slides which are reading slides. So we can't like really memorize them. What exactly is ADR? What exactly is GDR? Probably reading and rereading will help us. This is something that I am encouraging you right now, that if you have just understood the process, so I'm pausing over here. If you have understood this process, that Infosys wants to have a way in which the investors of NYSE or NASDAQ or any other fund firms, they can purchase and become part of their equity owners, even though it is indirectly. Then what is that way? This way is via a depository or custodian bank, and is known as a DR, depository receipt. Any problems?
Ma'am,
Yeah.
ma'am, I wanted to ask.
Yes.
So the US investors are the holders of these DRs,
Yeah, right.
and the banks are the issuers.
Correct. In this case, the banks have got it from Infosys, but they are issuing the DRs. Infosys have transferred the shares. They are converting these shares into DRs. I mean, we have to have a way, now. How will we differentiate otherwise? So this is how the differentiation comes.
Ma'am, in this we can say that depository receipts is the shares only.
Indirectly. Indirectly, yes. Shares only. Perfect.
And ma'am, if we are in India and we want to purchase some US security, then it is called what?
Then it is a foreign security for us, and there are a couple of ways we can do so. So there are certain firms which can help you, certain stock broking firms which can help you. There are also some fintech firms which can help you, like Ind Money. You can also purchase mutual fund units in India, which are further investing in US or foreign securities. So there are few ways, but you have to get hold of at least one of the ways to invest in a foreign security. Okay, ab gya?
So ma'am, they don't have any tag like these depository receipts.
So they will DR is a universal word. What can happen is that if a US based firm, now what can happen is that this bank can be here in India, they will transfer these shares to India. Next, what will happen is that the Indian banks will issue DRs on NSE BSE. It can happen anywhere. DR is a normal term, common term for any foreign security.
Okay, ma'am.
Okay.
Yes,
Now what we have is, we have two differences. I'm already telling you, this is a material which you have to read, you have to reread. First time reading, etc., you may not be able to memorize everything or all the characteristics. And this table also is like a homework from my side. You can just see it in the next slide when I come there. Now we have something known as ADR. So DR we are through. Now we have something known as ADR. We have something known as GDR. ADR is probably, you listed on American stock exchanges. ये तो मैंने भी example बताया, NYSE etc. American stock exchanges or exchanges I'm written. GDR is global depository receipt. Global DR, global depository receipt. ADR is America's depository receipt or American depository receipt. Then this is outside US or America, whatever we want to call it. Okay, one and the same thing. So a DR listed outside US is called GDR. The one that is listed in America or US is ADR. This will be in more or less US dollar. Now the beauty is, here GDRs are also in US dollar solely because it caters to foreign stakes, foreign firms, and US dollar is one of the most common currency that all the traders across the globe uses. So the felicitation in US dollars is much more convenient. So that is why it has been done. Okay? So can you write this? And rest, please read it from my side. We'll be happy to take questions in our next class, which can be tomorrow, which can be anytime later on. Okay. After we have understood DR, there is a custodian bank. That's another technical word. Then we have ADR. Then we have GDR. But they both are actually more or less they will be in US dollars. And this table for you to understand much more about it whenever you have time, so you can read it this. And in any case, any question, I will be here. Again, we also have something known as global registered shares, and we also have something known as basket of listed DRs. So let me try to spend a minute because there is just a one line each over here. We shouldn't ideally spend a lot of time, but I will still tell you that. Do you know what is ETF, exchange traded fund? So anybody? Exchange traded fund. Okay, no problem. So we have our exchanges, right? We have BSE and we have NSE. Over here in exchanges such as BSE and NSE, what is happening more or less we see that we can go out and we can purchase individual shares. That's what we have been talking about. We want to purchase Maruti Suzuki Limited share, Tata Motors. We want to purchase, let's say, Indian Oil Corporation, ONGC, HDFC, SBI, Reliance, etc., etc. So we can go there. There is also something known as a basket or portfolio of shares. So over here, we can have all the important or topmost banking stocks over here. We are creating a portfolio. That means more than one share. Important banking stocks. And we are putting them in a basket or a portfolio. So here we will have like Kotak, Yes Bank, ICICI, HDFC, not to forget SBI, etc. If it is also traded on a stock exchange, just like individual shares, it is known as ETF. Exchange Traded Fund. What is this fund? This is the fund, basket of securities or portfolio. Okay? Likewise, what we can now have is, further on what we can have is, we can create an ETF of DRs from many countries. Like we can have some which are there on your America, some which are there, let us say, on your London Stock Exchange. So some DRs which are listed on your London Stock Exchange, some which are listed on, let's say, on Germany Stock Exchange, etc. So we can create a portfolio of listed DRs. Listed DRs. Likewise, yeah.
Nifty 50 is an ETF.
Sorry?
Nifty 50.
No. Yeah. So we have an ETF based on Nifty. Nifty is just about, it is an index. Nifty, if you just call Nifty, it is an index. But we also have an ETF which is being traded in the market known as Nifty 50 ETF. Okay? So with this, we can purchase the whole basket of top 50 stocks. Nifty is 550 stocks now. So we can purchase the whole 50 stocks. Here, if it about banking stocks, there were 10 stocks that you can purchase together. So there is two options. You can purchase individual stock, you can purchase group stocks. So group stocks is the ETF way on an exchange. Okay? Is it okay?
Yes, ma'am.
Yes, any other doubt?
Yes, no, ma'am, no.
Okay. So likewise, you have a basket of listed DRs. I suppose that, let us keep it simple. So we are here in an American exchange, let us say New York Stock Exchange. What are the listed DRs? Infosys, listed DR, Tata Motors Limited, listed DR. This is from India. There could be many other countries, firms from many other countries. So if you combine them in a portfolio, That is known as a basket of listed TRs. Okay, that is there on an exchange, and you can also do. So there are, like, our capital markets, they have advanced. So we have got a couple of options right now in front of us. That's it. Okay. So now it's like a lighter slide. Finally, we have a lighter slide that you have raised money via an IPO. So the firm, it has raised money via an IPO. It has got its proceeds. It has got, let us say, $1 billion. I mean, I'm being super optimistic. It has got $1 billion. Where will this firm use this for $1 billion? Okay, so that is the importance, the role of our equity securities. They can purchase long-term assets, for example, machinery, plant and equipment. They can also undergo R&D activities, research and development activities. They can launch new product lines, or they can venture into new geographies. All right. So what really happens is that during the IPO time, so you you sold your equity securities. So this is the firm. This was your capital market, or we say the market. You sold your equity securities, and here sellers came. And who were the buyers? Buyers can be like you and me. So we say buyers can be our retail buyers. It can also be the big buyers, which are our institutions, mutual funds, pension funds, etc. So that is why this line has been written. Equity security, it provides a currency with the help of which firms can buy and whatever. And why would a buyer want to buy this IPO or a firm security? Because it sees that, yes, very good, it has a good, there are so many buyers and sellers. That means liquidity is very nice, and the company's financial performance and financial kind of position, its solvency, its liquidity position, that is also pretty solid. So if you believe that all the parameters of a firm is good, you would also want to put in money as a buyer, and you can come to the market, a financial market, and buy. Okay, so this was actually a lighter slide, but still, if there is any question, you can let me know. All right. So now we have something known as book value per share, or book value, or let me not call it per share right now. We have two concepts: book value, market value. So see, CFA level 1 is intimidating to some. Okay. Intimidating means frightening, burdensome, whatever you may call it. It can be to some. 99% it is because it is having a lot of, for you guys, every slide, every chapter, every LOS is telling you about some new terms which you have to kind of become comfortable with. My biggest advice, if you really wish to clear, and you will clear CFA level 1, my biggest advice is stop this memorization part. Stop taking this burden that so much I have to remember on my exam day. That's a futile exercise. The only way to go about it is to kind of read, reread, revise, re-revise with the help of your books, as well as with the later on with the help of your mock exams or your sample questions, or whatever it is, your practice questions, with etc. Do not take this whole burden right away. How am I going to learn so many terms? If you are at a particular point in time, so the way I told you about what is the difference between common shares, preferred shares, what is the difference between a domestic equity or a private equity, public equity, domestic equity, foreign equity, what are the additional risks? If right now you are able to understand, you are winning the game. Trust me, you are winning the game. But you will start losing the game if you will start taking the burden. We have to take the burden because we have to pass. Okay, that is done. But in a sense, we should not lose our confidence. Okay. So again, the thing is, I'm again going to tell you some terms, and that's I mean, there's no other way, because this is what our CFA level 1 curriculum is all about. And trust me, it has been crafted very well, will give and reap us benefits and super benefits, not just for level 2, level 3, but for the entire lifespan. I have known people who have stepped into for their first job, they began as a typical role of a CFA. They are still here. They have no plans to exit. So people, they spend their whole career. And if you want to spend your whole career or a substantial part of your career, we all have to put in this extra effort in the beginning part of our career. Okay. So book value per share, something known as then market value per share. So book value per share is, we have something known as profit and loss statement, which all of you know. In profit and loss statement, and then we also have something in our balance sheet also. We have our assets and we have our liabilities. In our liabilities, we have something known as the equity. So the equity portion, whatever is the amount that we can see in the balance sheet, is known as our book value. Okay, this is known as our book value. And there is also an equation known as assets is equal to liabilities plus equity. So this equity we can also get by this one. This is like our accounting balancing equation, as we call it, if you have done 11th and 12th in commerce. So equity is equal to assets minus liabilities. Liabilities here, all of your liabilities which are not your equity portion. Okay. So this is your book value. But what is market value? We have been talking about that there is a stock exchange. You get your stocks traded. So then the current market price. The current market price at which today the stock is getting traded, current market price, multiply by number of shares, multiply by number of shares. So what is this? This is P multiply by Q, gives us market value of equity. Can we read this? Book value of equity, value of firm's assets on the balance sheet minus its liability. And it increases when we have a positive net income and retained earnings that flow into the equity account from our P&L. Market value of equity, total number of shares outstanding, and then multiply by our market prices. Any issues?
Okay. No, ma'am.
Great. Even no is really welcomed. Thank you so much. Next, we go on to a very important, most important rather in equity for us. Most important. Let me admit Manya. Okay. Most important financial ratio. Financial ratio. So you will learn more about the financial ratios in your FRA. Here we have one snippet, one example of return on equity as a financial ratio example. By the way, what is a ratio? Ratio is simply an expression of your numerator upon denominator. Na? Numerator upon denominator. What it helps us is, it helps us in comparing values. It helps us in standardizing values, etc. So those are the helpful ways why ratios are used. One such ratio is known as return on equity. Up till now, we were discussing, we want to buy equity. We want to become equity shareholder, whether we want to become equity shareholder of a public company, of a private company, of a foreign company, XYZ, whether preference, where common, XYZ factors, etc. Now, what is stored for us? We want to become. What is it that we will get out of it? What is stored for us? Stored for us by this firm. And why should we invest or become equity investors in this firm rather than any of its other competitors or any other firm? So why should we become equity investors in A firm rather than in BCD? One of the ratios, there are many other ratios, but one of the very powerful ratio is known as your return on equity. And what is the return? That is at least on books. On books means on your books of accounts, in your annual reports. At least on books, what is it that we want? That is nothing but your net income. That is your return. And what was your original total investment? So we are actually combining the equity ownership positions and whatever the amount was given to the firm by all the equity investors, all the shareholders put together. That is nothing. It will again come from your balance sheet side. balance sheet, equity portion. And you can ask me if even these terms are not clear to you, equity on the balance sheet side, net income, etc. So next what we have to do is net income from our profit and loss account. If we divide it by our original, or rather the investment that we have done in totality, of all that has been done by all the equity investors in the firm. So from our balance sheet, we will take the equity portion. If we divide this is known as a metric, a financial ratio known as return on equity. So how will it be useful for us? So one example I have told you, as investors, we will now run the formula and we will see A, B, C, D. What are the ROEs? What are the ROEs? For A, it is 15%. For B, it is 33%. For C, it is 10%. For D, it is 12%. So 15, 10, 12, and they're all like, the same competitors. So we can see the looks like for now, B is doing a better job. It is giving more return to its equity holders. Can we also say because it is giving us more, maybe the management is better? Okay, maybe the management of B is better than A, C, D. So that is why we also say that it's a key ratio to determine management efficiency. That's your accounting rate of return, or you can normally say just your return on equity, and referred simply as your ROE. Now we have two options to calculate the formula. Can you write these formulas? See, we must write these formulas again, and again. We must have our own formula sheets. Towards the end, though, I remember I used to give like one full day dedicated to that. That was my revision time in the last 15 days. In the last 15 days before the exam, I used to give, and I'm not joking. So in one day, see, I was never able to give. Whenever I used to study, I used to be very, very productive. I never studied for, let's say, in these last 15 days also, that I'm, right from morning till night, and I am just studying. Because I was not able to do so. My daughter, she was just a toddler at that point in time, hopping over at all point in time. If I were to show you the snapshots of my curriculum books or my other prep books, etc., you would see that what kind of genies and what kind of Donald Ducks and whatever she has done directly on those books, etc. So I never had time. So whatever limited time I had, and secondly, I was not able to concentrate more. So I only used to, even in those last few days also, I only had about, let's say, a couple of hours, 4 hours, 5 hours at the max. I'm not joking to you all. But what I have always done is that I began early on. I began like, let's say, 7 months, 8 months before the exam. And I was consistent, but I never used to even study for more than, during those days also, for more than 1.5 to 2 hours. I'm being very, very honest to you. My daughter used to go to her school. It was still nursery for her, or whatever, probably KG class, etc. She used to be back by 12:30. So anything I could have done between, and there were other things also I was doing. So for level 1, at least I had that liberty, because I had taken a break from the corporate world at that point in time. I resumed then again after a few months. But even if I had the whole day with me also now, I mean, I'm not someone, I'm telling you all very, very frankly. But when I am on it, when I am studying, probably I will make the best of it. I don't want to quote that, okay, I will do 3 hours in 1.5 hours. I don't want to lie or say anything to you. But when I'm studying, I was very honest. I was very regular. I was so gung-ho. I had to clear all the levels and become CFA charter holders. This formulas, you must not even write and rewrite. You should create your own formula sheets for all the 10 topics. Okay? That's what I did in one of my last days. So let's write. There are two formulas for us for return on equity. One says that, you go to your balance sheet. You go to your balance sheet, there is something known as 2019 data. There is something known as 2020 data under your liability side in your equity portion. One formula says that you take the average of both the years. That's the first formula probably here. The second formula says take the end figure. This is the beginning figure. This is the end figure. First formula says average of your beginning book value. So this is nothing but a book value of equity, beginning plus your end, average. Second formula says directly take, but over here I see the beginning part. So let's stick to the curriculum because there are plenty of options when it comes to financial ratios. We should always and always follow what curriculum tells us. Here it is the beginning. So you take the beginning equity and the numerator will be your net income only, net income for the year. So can you please write down these formulas? We have got two formulas. Net income divided by average of beginning plus end. Net income divided by just the beginning book value of equity.
So, ma'am, which method is correct?
Yeah, so over there you will be told. Don't worry, you will be told that probably the analyst believes that only beginner year is fine. There are also additional clues, so you can actually refer to your prep material. And over there, do you see that immediately after this, there is some paragraph written that where the first method is more applicable and where the second method is more applicable. So I'm reading from there. It says the first method is more applicable. That is your this one. This is more applicable. Where it is, first of all, though, matlab everybody over there, all the industry professionals, they are using the first formula only. So we say this is the industry convention. Or when we see that the book value is very volatile. So there is a very big differences in these beginning and end. So you want to try to minimize the volatility by averaging it out. Hai na? Average, this is the basic idea of averaging. So where the book value is volatile. So in your question, you will get clues that the analyst thought that, let me follow the industry convention. Then you use the first formula. Where the analyst believed that this is the book value is very volatile. Then also use the first formula. Then where to use the second formula? Here it is says that when the book value is stable, So this is like a complete opposite to over here. The book value is stable. Or the second thing that they are doing is that when you are, assessing through a number of years, you are examining ROE for a number of years. So 5 years, 7 years, etc. So over there also, this is what the guidance has for us. And I still believe that, you will have some clues in the question. So read the question properly.
Excuse me, ma'am.
Yes, please.
Ma'am, can you please explain the difference between market value and book value?
Yeah. Book value is, if you know now what is our financial statements, balance sheet,
Yes, ma'am.
income statement. In your balance sheet, you have something known as equity also in liabilities. The balance that you see, the amount that you see in your equity portion of balance sheet is known as your book value. This is your book value. Okay? Book value is clear?
Yes, ma'am.
Market value is that if Maruti Suzuki is being traded in the market at about 7,500, this is the price, multiply by the total number of shares outstanding. This will give us market value of Maruti Suzuki India Limited. But if you were to open its AR, go to its balance sheet, go to equity portion, the amount written, that is your book value of Maruti Suzuki.
Ma'am, is it like necessary that market value will always be greater than the book value?
No, it is not. And specifically what we have observed is with our public or we can say the public banks, the ones we call it as, which are not private banks. So our public banks over there, the book values are more than the market values. So it is a possibility. Anything is possible. So it is actually a good question. BV can be equal to MV. BV can be less than MV. BV can be greater than MV also. We have all the examples.
Ma'am, what are the factors?
So the factors is, and we actually have a dedicated, what we call it as a ratio only. This is a ratio. And this ratio is going to come in our last chapter, but I'm happy to repeat, no problem at all. This ratio is called P upon book value. This is your price per share, current price per share, divided by book value per share. So if this is, let us suppose, this is 2 times. That means whatever was your book value, if it was 1 crore, Your market value is 2 crore. Here we see that market is perceiving the company's stock to give better growth, cash flows, so financially it is very sound, returns to its stockholders. So that is why within this market value, it's again, it is P into Q. This P here, this is P, it is higher because again, you have probably also because a lot of investors, they see that this is a stronger company having a better management, and over there, they also foresee that your company will do really very well, and it commands a better premium than your book value. Also, it can happen that the demand of the stock is greater than the suppliers of the stock. So there are not many people who would want to sell the stock, but there are many people who would want to buy the stock. So depending upon this demand and supply situation in the market, your price can also be higher. Usually prices are higher for better companies. Usually. Exceptions are always there. Is it better?
Yes, ma'am. Like it's not really clear.
No, you can ask me. You can ask me. Book value is something which is coming from your accounting rules. Okay? Book value is something which is coming from your accounting rules. Book value. So book value in year number 1 at the date it was incepted, let us say it was 50 lakhs. Do you know how will this grow forward in the next years? We will keep on adding our retained earnings, or we say our net income rather. Okay? Portion of our net income which we have retained. So we keep on adding this net income and our balance actually keep on growing. It will also grow when we have our we issue more shares. We issue more shares. This is all about our book value. Book value, 50 lakhs plus all the net incomes. So today, after let's say 7 years, this book value now has become 1 crore, which is very good. It has become 1 crore. Likewise, in year 1, the current market price was, let us say, rupees 100. Now the investors, they were looking very closely at this company that, wow, wonderfully, very well. The company has been super successful, delivering such great net incomes and whatnot. Looks like to be a very, very stable company. They start demanding more and more of its shares. But the people who own it, they are not willing to sell it that much. So the price is higher in the market. I hope you understand this law of demand and supply, okay? Where there is more demand than supply, the prices are usually higher. So this 100, this only became double from 50 to 1 crore. This became from 100, it became 300. Okay? This became 300. So your growth in your current market prices was more. So that is why our prices can be higher, they can be different than our book value per share. Many factors. I am just touching 2 to 3 factors. There can be many factors due to which our current prices, they are different from our book value per share. Prices coming from stock market, whatever is happening in that stock market, sometimes what happens is that there are certain incidents. So, Russia-Ukraine war, or let us say the inflationary pressures, or some events, for example, when COVID happened, the prices can actually drop also. And when there are very, very good news in the markets, the prices can be up also. So this relation of market price and book value, it can actually vary. From time to time, it can actually vary also.
So, ma'am, the example that you gave, the market price is 100. So that is the price of price per share or
Yeah. Price per share. And over here also what we see is this is book value per share. So what we do is book value divided by all the outstanding number of shares. That is what we compare. So actually the detail is either in the last reading number 6, but it is definitely there in CFA level 2. That how do you exactly compute price per share is price per share, but exactly how do you compute book value per share and then you divide. This is on per share basis.
So, ma'am, basically book value is the real value and market value is it depends on the demand and supply.
No. So this is price per share, the current price per share, This is book value per share. This is actually coming from our accounting, conventions, how our accounting boards, they have asked us, etc. That we had some initial issuance, and we recorded it at 50 lakhs at that point in time. Then they are asking us to keep on increasing it with our net income, etc., etc. So then we have something known as the current, present book value. We can't do anything over here. Whatever was the initial issuance and whatever is the net income coming from the P&L, this is all there. When it comes to our market, this is what I'm saying. This is much more dynamic in nature. Much more dynamic in nature. So what is real and what is not real? I would want to say this is where we have to showcase us being a very good analyst. We have to start finding the reasons. Your book value per share, sorry, I have to admit, Vanshika, your book value per share can also depict the true economic value, and your market prices can also depict your true economic value. We have to find the reasons behind them. So probably more towards our last class and our CFA level 2. But I can again tell you from some other example. How do you want to proceed? Please tell me.
No, it's fine. Like we can do it again, like you told in the last class.
Yeah, in the last class also, I have to still see what exactly, if there is any numerical for this. Also your book value per share, I am sure that somewhere it will come and part of your FRA, somewhere, all these. But how is it very hard for you? Can you just forget about these, these numbers? But can't you just see that, you have been given so there is some policies around your accounting principles. You have to follow those accounting principles, and those are also fine, but they can be different from your market. So if you, I can give you one more example. Let us say, so who is this? Abhinav, sorry, Abhinav?
No, Ariman.
Ariman, can we just say like this, that you purchased a property. When you purchased a property, it became its book value, its cost basis. And you have some documents, and you also, because this property is not your property but your firm's property, it goes into your accounting books. So over there you had bought it at about 50 lakhs. When you now see what is in your market, what is happening in the market after about, let us say, 5 years. What about this 5 years? In these 5 years, the market value over here, it could be 1 crore, because there are different, the market is showing a different dynamism altogether. The property's value is actually much more in reality, and buyers are more than willing to give you 1 crore. And over here, you have to follow some depreciation, whatever, the way you will depreciate, etc., etc. So that will go on in your accounting books. Market value can be different. Sometimes book values and market values can be similar also. Okay? So it depends upon the business model. It depends upon the asset characteristics. It depends upon a lot of factors.
Ma'am, current market price and market value is the same thing, right?
Correct.
And book value is completely static now. It doesn't change now.
Book value changes every year, and that's what I'm telling you, that it changes. The addition is your net income. So from your net income, or as we say, what something that you retain, as we say, that is added every year to your book value, original book value.
Okay,
Yeah.
ma'am, got it.
Yeah.
So
I
mostly,
think Abhinav, I don't think you have done FRA till now, or how is it? I don't think so. Ariman.
Ma'am, FRA, no, ma'am.
Yeah. So when we will do FRA, it will become like super clear to you. We have to do so much. We will even prepare cash flow statement also. Forget about just profit and loss account and balance sheet. We will even do cash flow statements also. Over there also, we will see how these formulas are for our book values, etc. So don't worry. Can you just remember right now that one, we have our accounting conventions, something that is given to us by our accounting standards. And there is a real market where you will go and buy and sell. That is your market value.
Yes, ma'am. I got it, ma'am.
Great, great. Yes, I believe somebody else also had a query.
Ma'am, so ma'am, I just had a question.
Yeah.
So, ma'am, market value is better than book value in terms
If
of
yeah, if you were to ask me, what is that majority of the analysts thinks like, they think and they believe that market value is better than book value. In reality, the transactions that we do, IPO or LBO or M&A, whatever transactions that we do, they are hardly based on book values. Again, nobody will hire us. Book value is book value. Open the balance sheet. Open, go to the equity section. That's it there. Nobody will hire us. We will be hired to get the market values or true market values, in fact. Okay? And that's what, with the help of all the applications of valuation, of equity valuation, we will even arrive further that, okay, if this was the market value, is it a true market value also or not? So there is something even further we have to go from here. So let's take one by one. And currently, I can tell you that according to me also, this is my personal choice, this is my personal perception, market value is indeed better than book value. Okay. So, yes, Manya.
कुछ केसेस में ऐसे भी होते हैं ना जिससे बुक वैल्यूज बहुत कम होती हैं, अराउंड 10 रुपीज और सो
Maximum
और
होता ही ऐसे है. Maximum a majority of the time, if I told you that there were 3 situations like this, majority of the times book value is less than your market value.
बट मैम इतना डिफरेंस कैसे आ जाता है कि मतलब करंट मार्केट प्राइसेस जो होते हैं वो डिमांड सप्लाई की वजह से
वो par it is issued at par na, in our accounting books it comes at par na. So
Yes.
par value is what? Rupee 1, rupee 2, rupee 5, that is what? Or rupee 10. They're very low. Our par values are very low. Then multiply by Q. So the equity value on our books of accounts is actually low.
Okay, ma'am. And ma'am, I have another question as well.
Yes.
अगर मेंशन नहीं होगा कि लाइक इंडस्ट्री कन्वेंशन है, कुछ भी ऐसा स्पेसिफिकली क्वेश्चन में मेंशन है, तो वी शुड यूज व्हिच फॉर्मूला, द एवरेज वन और द बिगिनिंग इक्विटी? बिकॉज
see, I would want to tell you that, take some clues, or it is not written to us, right? It's not written. Can you also
I
see?
was
Is it
studying
written?
FRA. I was studying FRA yesterday. So what I noticed is the reason behind this is that net income is calculated over a period, right? And equity is calculated at a point of time. So average हम मतलब analysis इसकी proper
Yeah. Mostly तो जो भी हमारी हैं in FRA, mostly तो they are working on averages only. So had it been FRA, I would have told you that the first formula is better. But now we are in equity, and there is nothing which is mentioned over here that which is better. Can you see? Can you see from the material also? You can go through also. In FRA, I can also tell you the first formula is better. But when it is coming now to equity, unfortunately, we can't see. But they have given us 2 clues. So can we just remember these 2 clues for now in equity, that we can use the first one where it's in industry convention and book value is volatile. And if these 2 conditions are not met, so let's not memorize a lot. Where these 2 conditions are not met, let us use the second formula.
Okay, ma'am.
Okay.
Ma'am, I wanted to ask this.
Ma'am, what is this -1?
Which minus?
Book value at time t -1.
Yeah. So t -1 will be 2019 and book value at t will be 2020.
Okay.
Yes, please. One more person had a query.
Yeah, ma'am. Just ma'am, one example, like if there is a change in inflation rate, so we can say
Yes.
there will be no change in the book value, but it will change the market value.
Perfect, Ariman. Perfect. This is our corporate finance level 2. Perfect.
Okay.
It's actually a dedicated LOS in our capital budgeting level 2. Effect of inflation. Or there also, this is what we study, that what it will do on our books of accounts, but what it has done in the reality and how to take economic decisions. Very good. All right, with all of this, now let's go and can we just do this calculation? Can we all do this calculation? Although I truly believe this is more towards, let's say in FRA, etc. But please let us do. We have been talking so much about theory. So let's go over here and let me erase this now. So till the time, please, I would want you also, if you are fully able to, and I'm sure FRA ho gaya hua hai to, but I know, please, I know for a couple of you, FRA has not been done, but for the ones who have done, they can proceed ahead. Those who have not done, it's okay. I'm here for you all. No worries. Although we will talk in more details in FRA, but we will solve this. So here, this is our stockholder
Bill group
equity
point.
book value. Sorry?
Nothing, ma'am.
Okay. So this is our book value. This is something that we call it as book value of T, that is today per time period, current time period. A previous year is book value T minus 1. And this is our net income available to common. Can you please underline this word available to common? It should always be available to common. Okay? So check this very carefully. Sometimes in the question, it can be net income available to. So I will write, it's a tricky question sometimes. Net income available to, are you writing? To equity shareholders. And then somewhere you are also given preferred dividends. So now your formula is net income available to equity shareholders and subtract what we have to give to preferred shareholders. And then you will get net income which is available to common shareholders. Okay, so this is exactly what we want as our numerator. Net income available to common. This is our numerator exactly. Then this is our stock price. These are our shares outstanding. So let us see what is happening. So this is our current market price P. This is our shares outstanding Q. So first let's run our ROE formula. So here it is being run with the averaging out, the first one. So net income over here, we will take the current year one, 3526. We will take the average of these book values, 18,503 plus 17,143 divided by 2. And I hope you get this answer. If you don't get this answer, let me know. So this is your ROE. If you are a yes, okay. If you are asked market value, that is P into Q, simply 16.8 multiplied by 3710. 16.8 multiplied by 3710, 62,328.
Ma'am, I solved this ROE with the beginning equity method. So I got the answer 19.05%.
It will be different. Yeah, it will be different. Why? Because see, this is 18,503, this is 17,143. Had it been similar, have both of them been, let's say 1818, then we would not have got a major difference. So I would want to tell you for FRA, you go with the average formula. For equity, just kind of, remember that if it is looking volatile, if they are different, then let's average it out. And that's what we are seeing here also. So let's apply
we
the
can
first
say that
one.
if it is not mentioned that the book value prices are stable or something like that, so in the safer case, we should always do the average one.
Averaging out. Yes.
Okay.
So I hope market value is also clear. We have something in the stock market. We have the total shares outstanding, 3710. Then there is a term, how to compute book value per share. This is coming from your equity of your balance sheet divided by total number of shares, that is your shares outstanding of the firm. This will be your 18,503 divided by 3710. So what is the book value for one share? That is BVPS. So we will divide and we will probably get an answer close to $5. More understanding perhaps when we will, for the ones who haven't done, more understanding in our FRA. And likewise, we also have a ratio known as price to book value per share. We have computed price to book value per share. This was it, close to 4.99. This becomes our denominator and price is from the market, 16.8. And we get 3.37 over here. So we computed from very small data set. We computed return on equity and we used the first formula. Then we came on to market value, P into Q. Book value per share is for one shareholder. What is it that he has as book value? That just we have to divide it with the number of shares. So here it is coming out to be near to $5. Then price upon book value, simply current market price divided by book value per share. Okay, let's just do this one first now. Required return and cost of equity. So see, this is at the heart of our corporate finance. So we are going to actually deep dive what exactly is all of this, much more in corporate finance, but there is kind of a probably like a half a page in our prep book right now that we can see. So let me give you an introduction to what is required rate of return and what is cost of equity. There is some points right now. For example, this point that the expected return, it will increase. This is coming from a formula. This formula is in the last chapter. You will not be appreciate this formula, this point right now. So let us hold this. Can you just read right over here? Read later. We don't know the formula. This is coming also directly from the formula. This also is directly coming from the formula. So can we say that, we try to understand right now that what is the required rate of return, what is the cost of equity, but then we come back after we have done the last chapter and we have done the initial readings of our corporate finance. And here I don't see that there are any formulas presented, etc., etc. So it will be probably difficult for you. It will just like a theory lines which I can present right now. But the beauty will be when we will be doing all of that in that particular LOS, we will get to know that what is the required return, what is the cost of equity. Okay. So cost of equity. Before I go to cost of equity, it is super easy to see what is the cost of debt. That means a corporate wants to raise funds, or probably not raise funds, forget about that, also in the form of bonds, wants to secure a bank loan. What is the most important cost that this corporate has to bear year over year up till the loan matures? Anybody, please?
Ma'am, the cost of securing that loan.
Yes. Cost. What is the cost of interest? Interest. Manya is right. It is your interest payment. Periodic interest payment. This interest is your cost of debt from your firm or corporate's point of view. Now, this is like a straightaway concept. We have a bit complicated concept known as cost of equity. What is the cost of getting equity? You want to expand, you want to go into different geographies, you want funds, and you want to come and tap the financial market, you want to issue shares, you will get the money in return. What is it going to cost you? For this, for now, I will tell you, we have few models. The names of those models are written here. So can we say that and we are going to see them very nicely. But that is why I am saying this is something which we have to read later. Something known as dividend discount model, something known as capital asset pricing model. So can we just remember that with the help of dividend discount models and capital asset pricing models, we will compute cost of equity. But if you are right now, whatever the minimum I want you to understand is, just like cost of debt, there is a cost of equity also. And these models, they help the firms. And this required rate of return is nothing. It is just a mirror image. By mirror image, we mean it is one and the same thing, but from a different perspective. Cost of equity, and let me just use another pen right now. Cost of equity is from the firm's point of view, corporate's point of view. They will call. So if it is coming out to be, let me say this is coming out to be 10%. 10% cost of equity is from firm's point of view. From investors' point of view, again, this is 10% only. It is known as their required minimum rate of return that they require so that they will purchase the security. Just like this cost of debt is from firm's point of view. And what is it that the banks get? Banks also get, let's say here 7%. So here it is a required rate of return for this bank loan from the investor, who is nothing but, we will say stakeholder, but we will say bank over here. So from bank point of view, it is required rate of return. Likewise, for us as investors in market, it is investors required rate of return. It means one and the same thing. Is it okay? Two terms for almost meaning the same, perspectives are different. One is from the issuer's point of view, one is from the investor's point of view. That's it. So that brings us towards, yes, Manya, any question?
Ma'am, required rate of return is जितना minimum हमारे को चाहिए ही चाहिए.
Correct, correct. It is the
और
minimum,
cost of
investor's point of
equity,
view.
and cost of securities more than required rate of return.
No, no, no. It is equal. Required rate of return is equal to your cost of equity. But when you would want to take some investment decisions, what you will see is between the expected rate of return, Manya, and then your required rate of return. Expected rate of return versus your required rate of return. So expected required rate of return comes out to be 10%. The stock is giving you 15%. You will buy the stock.
Yes, yes, yes.
ठीक है? A required rate of return and cost of equity are one and the same thing. I can assure you, a very popular interview question as well. Means the same thing, just the perspectives are different. And where you are ending your prep material, can you see the last line? A firm's cost of equity can be interpreted as the minimum rate of return required by investors in aggregate to compensate them for the risk of the firm's equity shares. So they are actually the same thing only.
Okay, so required rate of return we are using in reference for the investors and cost of
Right.
equity in the reference of the firm. Okay.
Right, right. Okay, so for this one, please let me know if you can go through, you can flip through the pages, anything, or if we are set, then it is 4:45. We can take a 5 minutes break, and then we can begin with our next chapter. That is